Hey everybody, it's Tim. Just wanted to put this short video together to go few things with you here. The Fed meeting was today, and anytime there's a Fed meeting, I always like to put some sort of an update together, either just after the meeting or the following day. I decided to go ahead and do it today because of the reaction in the market that's already taken place as a result of a poor PCI report that came out this morning, and then that was backed up by Jerome Powell's comments after the Fed meeting and some of the things that he said. So anyway, what he basically said was they're keeping rates the same. We kind of already knew that they would do that, but the comments that he talked about afterwards, which was that the inflation remains more elevated than they would like, is sort of the comments that he made, and then additionally that unemployment remains fairly low, which is not truly accurate. Unemployment has been rising, especially if you look at a 3 or 6 month average. So he's a little off on that. But because he made those comments, that makes the markets believe that the Fed is less likely to make future cuts. He also talked about oil and the war in Iran and how that's impacting gas prices, and that's going to hurt inflation now and into the future as well. And so as a result, the market believes less rate cuts are likely as we go through the year while these things are going on. And so I wanted to go over that stuff here briefly, and I'm going to go ahead and share a little bit of information on the screen here. And this is the 30-year bond that you can see and what it's been doing. Currently, the 30-year bond is down 40 basis points, as you can see here. So that's pretty substantial. We had an alert to lock today because the rates rose so much after the Fed meeting that the lenders were going to be doing a reprice. So we received this alert to lock. I'm going to play it real quick just so you get to hear what they're saying on that.
Good afternoon. This is Dan Habib from MBS Highway. It's 3:19 p.m. Eastern Time. Unfortunately, mortgage-backed securities are ticking down to some of their worst levels of the day. They're down 31 basis points, and from when lenders came out with pricing, they're down around 19 basis points, and that's going to put lenders in a position to reprice for the worst. We had a locking bias in this morning's update after we got some hotter than anticipated and really surprising wholesale inflation numbers, which really started the market off on a sour note. And then we had mentioned that we had the Fed meeting this afternoon that we didn't think would be too bond-friendly. And sure enough, the Fed and Powell speaking at the press conference saying that, we didn't make as much progress on inflation as hoped. They didn't say too much or change the statement too much, but bonds are selling off a bit further on this news. So we wanted to reiterate our locking stance from this morning's update if you haven't done so already, because there's some more room for mortgage bonds to get worse. There is some support at that 99.01 level in the 200-day moving average, which could hold, but it's our job to tell you when lenders are in a position to reprice. And looking at the 10-year, there's some more room to go until reaching around 430. So the advice here is to go ahead and lock in ahead of a lender reprice for the worst.
So anyway, that was the information we got just here very recently within the last hour after the Fed meeting. And then this shows right now, he said they were down 31 when he made that recording. Now we're down 40, so it's gone another 9 basis points since then. And if you look here, right now it is just really bouncing off that. This blue is the 200-day moving average, and it's right on that line. Oh, it just bounced up a little, so that's good news. Went to 37 from 40, so it's bouncing off of that. And I think that we will probably continue to trade between the 200-day and the 100-day moving average, which is the purple. Will probably stay within this range for the time being, at least until the war ends, hopefully sooner rather than later. If the war ends, then I think we're going to see a bit of a reversal in this go above the 100-day and even the 25-day moving average, which is the orange, and then also above the white, which is the 50-day moving average here. So I think it will bounce above all of those levels if and when the war ends, because you'll see a reversal on some of the oil and gas issues that we're having, and that's going to help inflation. But until then, we're just going to try to stay in a holding pattern as we stay in between these two and not do anything crazy. Right now, I've got people holding off on some refinancing because of where we're currently trading. But once the war ends, it's going to bounce back pretty quickly before it falls again, and that's when we need to be ready to lock in as soon as that happens. So anyway, that's the update I wanted to make. The Fed strikes again. Every time Jerome Powell speaks, it hurts the market, and he certainly didn't let us down today. I'll talk to you later. Thanks.